The problem is not the index, or indexing. The problem is not the floor. The problem is that the annuity fees are double what you get with a mutual fund, and his commissions are 4x what he would get if he sold you the same mutual fund, same index, without it.
That's a fair question. And honestly, I agree with Dave Ramsey on more things than many people might expect. He's helped millions of Americans get out of debt, build emergency funds, and take control of their finances. But when it comes to fixed indexed annuities, I think there's some important context missing from the conversation. Let's talk about it. Before we talk about where I disagree, let's start with where Dave is absolutely right. Some annuities are complicated. Some annuities have high fees. And unfortunately, some annuities have been sold to people who are not a good fit for them. I agree with Dave completely on those points. Retirees deserve transparency, they deserve education, and they deserve recommendations that match their goals. But here's the real question behind Dave's argument. Why would someone accept lower growth potential when they could simply invest in mutual funds? That's actually a great question. The problem is that it assumes growth is the investor's primary objective. Many retirees aren't trying to maximize growth. They're trying to preserve what they've already built. Those are two very different goals. Let's imagine two retirees. Both are 65 years old. Both have $1 million. Retiree A invests entirely in the market. Retiree B places a portion of their retirement assets into a fixed indexed annuity designed to protect principal from market losses. Now imagine retirement begins right before a major market crash. That's not a hypothetical concern. It's happened multiple times. Let's use a simple illustration. Investor A starts with $1 million. The market falls 50%. That account is now worth approximately $500,000. Investor B owns a fixed indexed annuity with principal protection. The same market decline occurs. The account value remains protected from the market loss. Now ask yourself, which retiree is in a better position to generate retirement income? This is where I believe many annuity debates get confused. Dave Ramsey's advice is generally optimized for wealth accumulation. Fixed indexed annuities are generally designed for wealth preservation and retirement income. Those are completely different objectives. Comparing them as if they're solving the same problem often leads to misleading conclusions. Another criticism Dave often raises is commissions. And he's correct that fixed indexed annuities frequently pay higher upfront commissions than many traditional investments. But there's another side to the story. Many advisory accounts charge ongoing annual fees year after year. A one-time commission and an ongoing annual fee are not the same thing. The better question isn't, what is the commission? The better question is, what are the total costs over time, and what value is being delivered in return? So, is Dave Ramsey right? My answer is, partially. If you're 30 years old and trying to maximize long-term growth, I probably wouldn't recommend a fixed index annuity either. But if you're approaching retirement, worried about market losses, concerned about generating income, or trying to protect assets you've spent decades building, then the conversation changes. That's where fixed indexed annuities may deserve consideration. The bottom line is this: Dave Ramsey raises some valid concerns, but retirees deserve a complete conversation about growth, risk, income, and protection. The right solution depends on the problem you're trying to solve. If you'd like to see more retirement claims fact check videos covering Dave Ramsey, Susie Orman, Ken Fisher, the 4% rule, and other popular retirement advice, subscribe to the Annuities.net YouTube channel. And in the comments, tell me, do you agree with Dave Ramsey on fixed indexed annuities? I'd love to hear your perspective. Thanks for watching, and I'll see you in the next fact check.